My name is Janani and I'm a graduate here at the AASB. Today I'll be introducing our next session, which is Research Session 2, Accounting for Investments in AI, Evidence from Current Trends, delivered by Dr. Nafees Fahad. Nafees Fahad is a lecturer in accounting at Massey University. His research focuses on financial accounting and information processing in capital markets, with a particular emphasis on the application of textual analysis and big data analytics. He holds a PhD in accounting from the Auckland University of Technology. Welcome, Nafees.
Thank you so much, Jeremy. So let's get started with the paper that based on this is an ongoing work we're still working on. It's very initial stage. So my two co-authors are Mehraj Lora from Massey University and Tom Scott from Auckland University. So particularly, I have two options. So another paper was in last week with AASB. So either I have to come here or Tom. So I told Tom to go to Germany, travel 34 hours, and I pick the closest one. So this paper is on accounting for investment in artificial intelligence. So I'm just going to quickly go through what is currently going on right now. So what we can observe is that AI is pretty quietly become the part of every official job. The statistic shows that around 84% Australian, they are pretty much using their office job. From the firm's perspective, those non-AI specific firms, they are started to heavily invested on. And the recent trend shows that around 5 to 20% they are allocating for their IT-based budget. Now, the question is if AI really is a game changer, then the disclosure of that invest-specific information should be matter to the investors. But yet, regulators are very concerned about when they are talking about these investment-specific or the AI-specific discussion in the annual report, whether they are doing the AI washing or not. The main reason is that they are actually overstating about the AI rather than there is a presence of substance. So that's why it's become an interesting question to look at whether these expenditures should be expensed or should we look into as intangible assets. Now, by nature, the closest that we can look into is a software, but still it's still complicated when it comes to the AI. Now, we're just quickly going to go through the example of what sort of AI-specific development actually happening when it comes to the firm's perspective. Now, this is being reported for the West Firm CTO explaining how AI actually transforming their customer and team experiences. So what they try to do is that they try to integrate AI agent to respond to customer queries, and where they actually try to highlight that it actually significantly enhanced their productivity. In another cases, Bunning talks about pilots AI for their 55,000 strong workforce. So one of the challenges of Bunnings is that to try to understand the workforce because of the high reliance on the external workforce for the business operation. Now, what they look into is that they introduced AI agent for the workday skills, and they actually run a couple of pilot projects. And they actually highlight that based on this project with these, they actually successfully integrate that in their business model. And they're expecting that it will significantly reduce the time to hire and their associated cost, specifically for when it comes to the externally looking for their staff. Before jumping to what is the issue with the AI, with the accounting, specifically for the investment in the AI, I'm just going to quickly revisit what intangibles are, because intangibles are already sitting in our financial report. So the intangible in general sense is a non-monetary asset, which has no physical substance. It usually comes controlled by the entity and based on the past event. So it actually, they expect that it will generate future economic benefits. Now, when the tangible need to recognize, pretty much depending on its probable, whether its economic benefit, when it's tied to that or attributable to that asset will flow to the entity. Another challenge is that whether that cost of the asset could be measured reliably. So the reliability is always an issue with the intangibles. Now, I also like to point it out with these asset definition as well, because when it comes to the AI, should we consider the asset or not? So the asset definition is another tricky part with the AI as well. So in terms of asset, it needs to be separable, so you can separately show, you can identify it separately, as well. It has to come through from the contractual or the other legal rights. Now, for the AI, when we're going to talk about it, we're going to bring it back and try to look into whether it matches with or not, because this is another challenge with when it comes to the accounting for the AI, specifically for the investment in AI. Now, we're just going to go through with the software, because I already mentioned that the closest by nature, the asset that we can compare with the AI, investment in AI, is the software. But software itself is very tricky when it comes to the accounting as well, because already it's been quite complicated in terms of software as well. The complication comes from whether the cost could be measured reliably, whether future benefit is certain or not, because with the R&D accounting, whether we can separate clearly between hardware and the software. We're still struggling with this. Then comes the technical obsolescence, specifically when these systems become outdated within a very short period of time, like say 2 years or 3 years, whether we can do this or not. And then comes the software as a services, specifically the control issue, because who actually owns that asset when it has been coming from some service provider from somewhere else. Then comes the challenge with the maintenance and enhancement. So we already have an issue with the cybersecurity. So if a firm upgrade the cybersecurity, should they treat it as an improvement or not? And then the elephant in the room, we cannot revalue upward softwares. So even if the market price is higher, but we cannot put that as a upward revaluation to reflect its true value. So this is the challenge with the software. Now, when it comes to the AI, things are much more complicated. Again, the future benefits are, again, very uncertain. Most of these projects might not be going into the development phase. So if I come across a recent MIT research where they find out that out of these AI specific, within this bubble, AI bubble, out of these investment, 95% of these AI specific investment project didn't get success. Didn't see any sort of success or anything. On those 5%, still they're struggling because they are not certain how far it will go, because they cannot predict how much certain it is when it comes to the economic benefit. Now, AI is a cloud-based system, so that's why it raised a very important question about the control and ownership. Now, another issue is that firm can bring those AI-specific model and they can train it. And when they're actually training those model, like means fine-tuning those, it actually create a lot of data. Now, the question is, who actually own those data? And how are we going to treat that as an asset or not? So there is a gray line with the cost of the data as well. Now, these issues raise a significant challenge for accounting, specifically investment in AI. Another issue is AI is iterative. So how can you isolate between what is the development and what is the enhancement? Because it comes with the training as well. Now, with the training, we cannot capitalize with staff training, but maybe we can do with the AI, because they are not leaving us. So it's going to stay there and we can have a long-term economic benefit out of it if we can keep training that. Now, when these challenges coming, there's an important question is raising, is that it creates a new consensus opportunity or not. So we need new knowledge or expertise for that. And the quick answer is yes. One of the mainly two reasons behind that. One is rapid AI adaptation. So companies across different industries, they are heavily investing on AIs for their internal operation, as well as those customer-focused products. Now, with these, it actually raises a very important accounting question. So when these AI spending actually happening, so how you should treat that as a software, R&D, or as an intangibles. And the fact is that the company actually need guidance. They don't know how to classify this, specifically how to recognize these, how to amortize these, or how to disclose this, because there is no prescribed way of doing this, because there is no prescribed or any guidance is there available for them. Now, another issue with the complex accounting standards. So the current accounting standards, specifically the IS 38, intangibles, and ASC 35730 under US GAAP, when they are preparing these standards, they don't keep that mind specifically for the AI. So maybe there is some sort of indication is there, but not specifically for the AI. Now, that's why determining these investments specifically for the AI is a really big challenge, specifically for the capitalizing expenditure expense or for the disclose. And this is an important question of we need specialized knowledge and judgment. And that's where these firms actually lacking behind with their in-house expertise. And that's why there is a higher demand for consultancy for this specific need. All right, so what is the current disclosure look like right now with the AI? Now, with the recent research publication with these, they're showing that still annual report and earnings, not that higher upward trend with that, but still it's more like they are communicating a specific issue with the analyst through their conference call, not through their annual report. So there is a peak, but still it's not that much. Now, what is the prior research is looking like? So it's just still we lack in specific prior research in specifically for investment in AI. But if you look into the past, specifically for the software development, so 2/3 large Australian companies, they usually capitalize this software development, which is about the mean global range. And the research shows that when they capitalize that, they actually improve the disclosure quality because it reduces the information asymmetry and reduce the IPO underpricing. And most recently, this paper come from Messner et al. From 2025, where they shows that when the AI-related disclosure is not more specific and not trying to do AI washing, it shows that it is associated with higher firm value and efficiency. But this is not specifically related to AI disclosure. So this is more they try to capture through AI job advertisement through that cost, but specifically they don't talk about what sort of AI specific disclosure actually happening through that. So that's why based on these apps, the limited number of research specifically for the investment in AI, we try to draw this research question about how do firms disclose investment in artificial intelligence and what they're actually disclosing right now. To try to look into that one, we rely on annual report of ASX 200 over 2023 and 2024. We exclude financial rates and funds, and we left with 280 observation for both years. And there is no AI specific firms, no AI specific firms. Now, the first step we try to, so there's a two-step we actually follow to look into what sort of AI-specific disclosure actually happening. The first, we try to look into whether there's a recognition is happening within the financial reporting or not. So we manually check balance sheet, income statement, and notes for any related work, but we find nothing. Now, AASB 101 says that any sort of material information needs to be disclosed separately, but we couldn't find that. And that's actually raised a question about so that means AI is not material, or they aggregate that with IT. To get a little bit of perspective on that, if they are aggregated, then how it looks like when it comes to the intangible. So if you look into that descriptive, most of the firms have their intangibles, but interesting fact that the subsection of those items, which actually fluctuate a lot. And interestingly, what we find is that for the software assets specifically, which actually grows 10% compared to 2023. So there is an increase, there is a jump, but still we cannot say, is it because of the integration of AI or any sort of AI? Now, when we don't find anything through the recognition, the next thing we try to capture is a way they actually try to talk anything about AI throughout their annual report. And we rely on textual analysis where we use a keywords, AI-specific keyword, list of AI-specific keywords. And where we find that 40% of firms, they actually mention any sort of AI-specific discussion throughout the annual report, and in average of 2.7 words. Another thing we try to capture is that when they try to talk about the AI-specific discussion, whether just mentioning the AI or they are some sort of commitment, or they specifically mention why they are using their AI. Now, this is a challenging part. So how we can isolate that one? So we're relying on LLM, and we asked ChatGPT to look into to specify these, whether they try to talk about specifically or commitment specific. And those highlight that if it is farm specific, those are green one, blues, those are a blue one. And this one is coming from South 32 Limited from their annual report. And another example is that when they are not committed or specific, then how it looks like. So for Agro Investment Limited, for their annual report 2023, they mention about artificial intelligence, but there is no specific commitment or specific. They just mention to describe a specific situation, like what sort of AI specific development is happening, but not from their perspective. Now, when we draw based on those paragraphs with the word cloud, this actually give you an interesting perspective. So AI is surrounded by mainly by data, business, opportunities, so technology. So when these AI specific discussion happens, so they actually try to talk about these data specific, business specific, or technology specific. So they try to use AI when they try to talk about it. Now, who actually disclose more AI information? So when you test that, we find out that firms that are larger with a lower leverage, higher market to book value ratio, more profitable, more investment, they disclose more AI specific disclosure. So they actually talk more AI specific. And next thing we try to look into, does it matter? So we try to make a causal link between market value with the earnings and the book value. And we find that market value higher when they try to talk AI more, but we find more stronger association when they try to talk about with a more commitment and more specifically. So through these findings, one thing we can we try to understand, so that does market see through the AI washing? So since we found a little bit of strong association with when they talked about more specific and more committed way, we find a stronger relationship. That means market try to look through, but still we cannot say 100% of that. So to sum up, what we try to do is that, so firms are heavily investing in AIs, but there's a discrepancies between what they are trying to talk about and what actually reflecting through their annual report or financial reporting. So there is a huge gap in that. So maybe they are start investing, but still it's not reflecting through their annual report. So there is a huge gap is there, so that we need to address that. Now, we talked about that, the concern about the absence of guidance and the prescribed manner of how they can disclose AI. So there is no prescribed manner, they know how to do that. And that's why their expertise is required specifically for the knowledge and the judgment, specifically for that when it comes to the investment for the AI. Now, the regulatory concern about the AI wash is overstated. Maybe not. I think there is a AI washing. So greenwashing, diversity washing, every sort of washing is happening. So why not AI washing? So AI washing will be there. So you cannot exclude that. So it will be there. So, but how we can make them more commit and how we can make them to disclose that specific information more transparently. So that could be the challenging part. And we actually try to draw standard attention about, so please consider that how they can target the AI guidance on the life cycle, maintenance and training issues. So these are the things they probably look for, how to deal with AI specific. So that will be pretty much all from my part. So thank you very much for your patience.
Thank you, Nafiz. Now Nafiz will be joining us in the panel. So staff would like to remind again that views presented in the panel discussion are personal views and don't represent panel member organizations unless explicitly stated. I would now like to introduce our distinguished panel members who will be joining us on stage, introduced in alphabetical order. Dr. Dean Ardern, please come up and join us. Dean is a partner specializing in IFRS and corporate reporting at BDO Australia. For over 15 years, he has advised on interpreting and applying IFRS and other financial reporting matters. Having worked across for-profit and not-for-profit sectors, Dean brings a deep knowledge and practical insights to complex accounting issues. Michelle Harrison, please join us. Michelle is Director of Financial Management Advisory at the South Australian Department of Treasury and Finance. She oversees the South Australian Government's financial management and reporting frameworks and leads whole-of-government sustainability reporting. Michelle also represents South Australia on the Heads of Treasury Accounting and Reporting Advisory Committee. Next is James Melton. Please join us. James is a senior investment analyst at UniSuper, overseeing infrastructure and private equity investments. Previously, he was a managing director in PwC Australia's Corporate Value Advisory practice, chairing their National Technical Values Committee. James serves on the International Valuation Standards Council Business Valuation Board, the CAANZ Business Valuation Committee, and facilitates CAANZ's Business Valuation Specialization at Macquarie Business School. The next panel member is Professor Ian Opperman. Please join us. Ian is co-founder of ServiceGen, an industry professor at the University of Technology Sydney and member of the board for multiple deep technology startups. Ian is also the chair of the Commonwealth Data Standards Committee and an advisor to the Tony Blair Institute for Global Change. Next is Ram Subramanian. Please join us. As CPA Australia's external reporting lead, Ram oversees advocacy, thought leadership, and external communication activities that spans topics relating to external reporting that are central to CPA's membership and the broader accounting profession. Ram leverages his expertise in IFRS accounting standards, public and not-for-profit sector accounting, and governance matters to drive CPA Australia's external reporting agenda. The session will now be moderated by Dr. Eric Lee, our AASB Research Director. Please join me in welcoming panel members and moderator. Over to you, Eric.
Thanks, Janani, for the kind introduction. So as you can see, we have a very good mix of panel members. We have panel members who have specialized in data. We have someone who's from the public sector, valuer, for-profits, and also from the professional body. So we have a lot to discuss, and feel free to ask questions while we're having the discussion. So as what Nafiz had mentioned just now in the presentation, it seems like when we talk about data and AI, the stakeholders are thinking about two things. The first thing is that how or whether organizations have been using AI and data in a responsibility way. That is responsible use and disclosures of AI and data. And then the other part of the story is that should entities recognize, disclose more data or recognize them as intangible assets on the financial statements. So there are two parts of the stories. So the very first question I have is, let's understand more about what the data environment is and how AI works in the practice. So I'm going to ask this question to Ian, who is the chair of the Commonwealth Data Standards Committee. Could you provide us with a brief overview of the role of the Commonwealth Data Standards Committee and what are you working on and those challenges you have been encountered since you joined the committee?
Thanks very much for the comment question. So the data standards body is the body that's responsible for creating standards for consumer data right and also for digital identity, and the two of them coming together is a relatively recent activity. A consumer data right, of course, is about moving data about us through financial institutions and in not just in finance and in banking, but also now in energy and soon non-bank lending. The original idea, of course, was its an entry point for a completely seamless, joined-up digital economy. But in practice, the reality has been that it's actually hard to get these things going. There's a lot of work that's been put into protecting privacy and security. And there's a lot of infrastructure that's been built before those first use cases came out. So on the consumer data right side, it really is about us moving our data around more freely, data about us, data about our accounts. In the energy sector, it's also data about preferences. And the digital identity, of course, is about how you prove that you are who you say you are for various different government services. So some elements to that, an on-ramp and some rails to keep moving data around.
So this morning we heard that not all data is the same.
Absolutely.
Yeah. Can you give us a bit more background on that? What does that actually mean?
This is one of my absolute favorite topics. And just be warned, if you ever ask me about data at a party, just back away slowly as I start to lead into this. So I spent a lot of my time thinking about data. I used to work at New South Wales Government before that I worked at CSIRO, before that I worked at Nokia Networks, which is the part of Nokia that still exists. And data is far more than we think it is. Data is traditionally thought of as rows and columns, structured data. Then we started to break into the idea of unstructured data, so reading reports and so on. But at CSIRO, we were putting backpacks on bees and getting data about where bees flew and where they went all day. And then we made them IP addressable. So we had the little Internet of Things that we established. We had spinning lidars that would allow us to capture information, a 3D watertight model of the rooms that we were in, or a Boeing 747 as it was being constructed. And we also created data sets around all sorts of weird and wonderful things, because what we wanted was deeper insights as to how to understand the problem in front of us. So data is a way of seeing the world. Data is a record of things that have happened. Data is a point of light, and every data set is incomplete. Every data set is biased. Every data set does not give you full coverage, but every data set gives you an insight into a complex view of the world. So part of my wife's a barrister, background is intellectual property and copyright. We have argued about what data is more than is healthy in any relationship. But the intangible, or whether it's a durable good or what it is, the concepts we have about data, I suggest to you, are not really fit for purpose when we think about just how many types of data there are, how many forms of data that we create or touch or interact with every single day, and how every single person on the planet can use every single data set, if they could access it, in a completely different way, and everybody would generate different value from it. So it's a really unusual thing, this thing which we call data.
Thanks, Ian. So, Ram, having heard what Ian just explained about the complexities of the data characteristics and nature, have you heard consistent feedback from your members about how data has changed the business practices and the thinking of whether data should be recognized as intangible assets?
I think it's without doubt a point to make that data is king, regardless of what you do. So we are hearing from our members who run businesses and practices and working in corporate sector and other sectors that data is absolutely essential to whatever they do. And quite often, the quality of data matters as well. And if the data that you hold is not of a suitably good quality, then it does affect the decision making that you make using that same data. So I think the data quality is quite important. And that's probably the main thing I would probably point out at this stage.
Okay. Michelle, what about in the public sector?
In the public sector, we hold some quite incredible data assets of our own in the provision of service delivery. Some of those data sets will help us, particularly with AI, give us further insights as to how to better provide those services. Some of those data sets in the private sector might be capitalised and used to be monetised. It doesn't necessarily follow that that's what will happen in the public sector. For example, the data set, which is the envy of the world, I'm sure, is that of the National Health Service, which has longitudinal data about the treatment of patients over decades, identified with a unique identifier for each person. That data set is absolutely incredible in terms of what it can tell about service delivery in a health setting. But you have similar type products being developed in the private sector. So you might have seen just last week, there was the twin that you could have in terms of what would this affect with my health outcomes? And that was, a monetisation of that data. So yes, we have amazing data sets, but how they might be used could be different.
Okay. Right. So the AASB has started its work on the intangible assets project. And one of the biggest challenge for the AASB is to scope how the project should look like, in particular about software, data, and also AI. From your perspective, what is the biggest conceptual barrier to treating AI as an asset, including identification, control, measurement, or something else entirely? I'm going to pose that question to Dean.
The one thing probably I would say that the point that's probably resonated from everyone's to me to this point has been the notion of capacity. So when I go out and talk to clients about capitalising, whether it be software, AI, when I'm talking to the IT people, generally the first thing they talk about is capacity. They're saying this will give us capacity to do X, this will allow us to do Y. And when they start talking about that in that context, they immediately imagine that we can capitalise it because they can identify or they can explain to you where they think the benefits will be yielded. And then when you have to expose to them and say, sorry, we've got an accounting standard that's 30 plus years old, was written at a time, never anticipated AI, let alone SaaS, PaaS or IaaS. Trying to explain to them what that means in their world is a real challenge. And I suppose the counterpoint to that with the AASB, I would say that interestingly, if you look at the way standards have developed over time, the intangible asset standard hasn't changed in 30 plus years, whereas the business combination standard has changed quite significantly in probably 10 years. And both covers off intangible assets in different contexts. Whereas if you're in the business combination standard, you only need to be able to effectively demonstrate that you paid more for an entity than what its underlying net assets are. And the difference is ultimately goodwill, but I think you'll find increasingly people are describing it as synergies. And I think those synergies going forward are going to be IA-related synergies. And it's going to be interesting to see how those disclosures around business combinations going forward to start to change. But the interesting thing, if I go back to the clients that have they're trying to onboard some IT, they're trying to onboard AI, they're saying we have capacity, they've spent money, but the argument would be that under the standard, you don't control that, there's no benefits, you can't identify it. And I suppose you'd make the same argument when someone identifies AI benefits in a synergy, they have that same issue. To be able to quantify the benefits, they're going to struggle. To actually say they control those benefits, they're going to struggle, and yet the asset would still be there. I suppose that's in a summary.
No, that's really interesting. I haven't thought of these synergies disclosures where entities may need to think about how they integrate technologies and AI as a whole entity. Ram, do you have the same view, or do you have other views on this?
I think synergies is an important point to consider.
Yeah.
The AASB is, of course, running its project on intangible assets. But I think it's probably important to accept that financial statements themselves may not be the necessary answer to everything to do with intangibles and how intangibles are captured and displayed as information. So there may be other ways in which that information can be presented. So, for example, the IASB's initial research indicates that users are not necessarily so much interested in the different types of assets, specifically in relation to intangibles, but more about the creation of business value holistically. So that's one of the findings that they've come up with. And they are looking at how to address that. But at this stage, they're looking at it from a financial statement perspective. But I think there's a broader issue here. And could we actually capture and present information around intangibles in a broader way? And if you look at AI as a subset of intangibles, potentially, there's a couple of things we need to be mindful of. And we've all heard of some of us would have heard of the 3 laws of robotics, which is a fictional set of laws which Isaac Asimov came up with, the science fiction writer. I've come up with my own 2 laws of AI. And they're not my own either. One of them is from my colleague Gavin Ott, who works in the policy and advocacy team. And his law is that don't fall for the hype. That's the first one. And the second one is from my dear colleague, Professor Michael Davin, who's sitting over there, which is that don't get the AI to do anything you can't do yourself. So I think there are limitations with artificial intelligence as we stand today. And I'll probably also just mention that CP Australia does an annual survey of business technology usage. The business technology survey report was just published a few weeks back. And there's a few findings in there around the use of AI and how it's increasing. So one of the questions is around the expectation of the use of AI in the next 12 months. And about 63% of people have said there is likely that there's going to be an increase in the use of AI in the next 12 months. It was around 25% about 3 years ago. So there's an exponential increase in expectations that AI will permeate what we do. But then another question was, the usage of AI. How often does your business use AI? About 40% have said occasionally, and about 9% have said they don't use AI at all. So there's still a significant proportion of people who are getting into how AI is used. So there's all sorts of limitations that we are currently seeing in terms of how AI is used, but there's no question that it's on the uptick. So we probably need to, coming back to your question, we probably need to give it a careful thought as to, is it really something that can be captured financially and measured financially and presented in the financial statements, or is there a better answer? Can we think around the box, outside the box a bit here, and look at other solutions which may sit outside financial reporting?
Thanks, Brian. Now, what about a public sector perspective, Michelle?
From a public sector perspective, I do think through the lens of a preparer about some of the challenges which were thrown up with accounting for software as a service. And I know that the AASB has looked at that in its initial stages in its project. But I think that was really instructive, those IFRS Interpretations Committee determinations in 2019 and 2021. But really gave us the idea that we've got to be really careful about whether we actually have control and through what lens. So I think it's going to be an interesting thing to unpack further about how comfortable we are with the concept of control applying to intangibles. Certainly what we've seen over the recent years is that shift with standards such as the revenue standard. It's becoming tighter, more legalistic, you might say. Are we comfortable, if we were to keep the framework concepts that we have, are we comfortable with where the intangible assets is pitched now with those interpretations committees, that context as to how to apply them? Or are the needs of users suggesting that perhaps we should be loosening that up a bit?
I think we'll come back to that question about control. I'd like to get your views about whether the IASB should rethink about the concept of control for intangible assets later. So we're going to move on to the next part of this discussion, that is valuation. One of the biggest problems, as we all know, in intangible assets is how to put a number on intangible assets, and whether the investors do trust, put faith to the numbers that are being valued. So we have a valuer here. I'm going to first ask the question about IOSCO. Recently just announced that they would hope the financial reporting standards integrate valuation standards. What is that about?
Thank you. Yes, so IOSCO, for those who don't know them, are effectively the United Nations of securities regulators, so the SEC, ASIC are members, and they've put forward a working statement with the IVSC, so the International Valuation Standards Body, on integrating IFRS and valuation standards. And this is quite profound in that, well, firstly, there's many different books you can refer to understand valuation principles. And I guess the nexus of the IVS was really to consolidate that into something that's global, best practice, transparent, consistent across markets. And now that's headed to the world of financial reporting. So I expect that this will be quite material for the IVSC in that it's obviously being broadcast now to a much wider audience. Of our member base, we comprise many different bodies, obviously the big four and accounting firms, but also other valuers in different aspects of the markets. The IVS are increasingly referred to in legal disputes as part of tax disputes, IP considerations. And so that global valuation best practice framework will now more heavily, or at least align with, financial reporting standards. So it's a big development for the organisation.
Okay. So in terms of, back to the topic of intangible assets, what are the valuation challenges or perhaps let's say the methodologies that you have heard that you think that may improve the business practice?
Yeah, look, I will emphasize the challenges aspect. I think as valuers, we rely on high quality information, and without those disclosures in financial statements, of which we probably all recognise it's an area of improvement, it does make it hard for valuers to discern AI in particular or other intangibles as value drivers. Coming back to first principles, the way we approach any assessment is to look at cash flows and risk. And so in many cases, when valuers are able to construct a narrative by way of company reporting, media reporting, what you can glean from financial statements and management discussions and so on, and emphasize glean with, of course, support, something that you can turn back to as your support, and that being transparent in your report is also very important. But when those things come together, a valuer is able to model the impact, certainly that certain intangibles have on the business value. Now, a lot of that work is done through business combinations, and I think that's part of this chicken egg debate with respect to most valuations of an intangible nature of a financial reporting requirement come from a business combination. So they fall out of a purchase price allocation. So valuers are traditionally trained in that methodology. But what we're seeing these days is increasingly the divide between enterprise value, these big tech companies, and the way in which they're realizing value that's far beyond what's reported on the book. There's an uptick in the way that investors are using valuation theory in order to understand value, and increasingly that is divergent from those more rudimentary or prescriptive intangible asset valuation methodologies that fall out of a business combination.
It's interesting. So this Wednesday, we'll have a session about valuation as well. And one of the findings was that the reports, the financial reports, that do not provide sufficient disclosures about assumptions and estimations from valuations. Dean, do you also have the same experience that, when you review financial reports, you can't get enough information about valuations?
Yes.
Okay.
Look, I say that flippantly, but maybe if I come at it from a couple of different perspectives, I'm not a user necessarily of the financials. And so as a consequence, I'm working with a client to ensure that they're producing information that's sufficiently robust and detailed to meet whatever reporting requirements they are reporting under. There is sometimes a disconnect between the quality of the information and the amount, so the quality of the information disclosed and maybe the amount of information that they have, because certainly there is some element of intellectual property or rights that they want to probably protect when dealing with these assumptions. But on the flip side too is that there is often reticence to disclose more than what's absolutely required. And I get it from their perspective, because sometimes those assumptions aren't, maybe the detail, often when you start delving into assumptions, the robustness is less strong when you start to dig deeper into assumptions, or you start to extend out your disclosures around assumptions. So anything that provides a framework, even a conceptual framework for users around disclosing, I suppose to Ram's point again, the idea about, is there a means through which we can disclose this information that would be useful, that doesn't necessarily have to mean a number is put on the balance sheet. That could be good, but you still need to probably have some guidelines around it to at least get you to a point where you can actually make some disclosures that are meaningful and comparable. To the point made before about the IFRIC determinations, to me, the fact that the IFRIC had to go to another standard to try and find some guidance to deal with intangible assets was a concerning outcome for me, because it meant that the standard didn't give them anything that they could work with. And so any work that the AASB does in this area would be beneficial, and I don't think they necessarily have to make it a full-blown project. Start small, build up.
Thanks, Dean. Okay, so I'm going to go back to a question about control, and I'm going to ask Ron this question. When we talk about AI, it's hard to not separate data out, because in order to run AI, you need data. And we know that data may not be necessarily fully controlled by an entity. So we come back to AI. Does AI challenge the idea of control in a way that our existing standards do not accommodate? Which come back to Michelle's point before, should we rethink the concepts of control in accounting standards?
Yes and no. I think the no first is because control has a very clear role to play with financial reporting. So it's an essential part of how we capture asset information in balance sheets, how we determine what belongs to the organization. And I think it's important that we preserve that fundamental element of financial reporting. So I think control is essential in how information is captured in financial statements. So that's the no part. The yes part is a bit more difficult because that's one that is where we are now stretching how financial reporting is handling value. And James talked about, valuers wanting to have valuation done of businesses in different ways. And financial reporting can provide that information, but there's other information that also forms part of the business story that adds to that value proposition. So if we looked at AI, as you rightly point out, Eric, it's not just about a piece of software. AI fundamentally is software driven, but it's also hardware driven. Chip technology has significantly increased in the last few years to support how AI has gone forward in leaps and bounds. And there's also the data. So, and as you rightly point out, not all the data belongs to the organization. And the answers that you get from AI is potentially based on data that comes from outside the organization. So how do you determine control in that situation? So that's hard. Of course, you can have closed loop AIs where everything is within the organization. So the data sets, everything is held within the organization. So probably in those circumstances, it's easier to determine control. But then control is just one of the tests. We're looking at other characteristics before we start placing a number on the asset, if you want to call it that is AI. So I think that's why I go back to my original point that we need to think about this a bit broader. And this goes back to some of the research that we did commissioned with the University of Melbourne a few years back called the Horizons of Reporting, where we were looking at expanding financial reporting to fit certain things into it, like intangible assets. And that is still an ongoing burning issue because financial reporting does have boundaries. And some of these things are stretching those boundaries and fall outside the boundaries as well in some instances, like with AI. So we have to find clever answers to these questions.
Really interesting comments. It sounds like technology has now challenged us to think about the boundaries of financial reporting. I've got a question from an audience, and I think I'll ask our valuer on this question, James. How does/should accounting deal with the fact that the value of AI and data varies with firm technological capabilities and business models?
Yeah, it's a great question. Look, the beauty of valuation methodologies is that they're largely comparison based. You'll know that if anyone's bought a property, and one of the things you're presented with is the dollar per square meters, and it's a similar exercise when you're looking at companies, right? Where we're looking at valuation multiples when we're doing a market-based approach, and implicit in those exercises is the amount that firms are spending or expensing on AI. And then what you're doing is looking at the proficiency, right? So you're potentially looking at some of these AI washed annual reports. You're looking at other publicly available information you can get. And at this stage, it's very similar to the early stages of sustainability reporting, where there's a lot of noise out there and there's no frameworks necessarily, but it is in any case prudent to run the course. And where there is a company being the target where it's a huge value driver, you need to understand how it stacks up against its peers on a relative basis, I would say.
Thank you. Another question coming in. If recognizing AI as an asset is too difficult or unreliable, is the better path to strengthen disclosures instead, which what the panel has mentioned? Should we think of AI more like risk, governance, and capability rather than a recognizable asset? Dean, you looked at me. I feel like you want to answer this question.
No, I don't want to.
You don't want to go for this
That's
question.
a good question. And yeah, no, I agree. It's actually an interesting way to look at it too. Because the conversations I often have with clients around this and capitalizing it is the discussion is a rule around capability and but risk. And, you know, there's some of the risk is if we don't do this, we'll be in trouble. But some of it is if we can do this, we can mitigate a whole lot of things as well. So I hadn't thought about it like that, but it's actually a really interesting way of thinking about it. So you're thinking about your risk expenditure and the way that it's can potentially impact other aspects of you, but you're probably moving into a different sort of reporting framework.
Yeah. Michelle, any
Well, it just makes me think of the parallels with risk disclosures with financial instruments. So I think at this point in time, perhaps it's early to think of it like that, but depending on how big this all gets, and, you know, I know, Ram, it might not be as big as all we say, but if this is going to fundamentally demonstrate value in businesses, you've got to think about, well, what information is useful to users. Perhaps we will need to have additional information about risk like we do for some of our significant financial instruments and those sort of concepts.
Thanks, Michelle. Ram, does it align to what you had thoughts before?
Yeah, just to make a comment, we've already got a framework that somewhat addresses this. It's called the Integrated Reporting Framework, which looks at capitals across multiple value drivers. So, and financial capital is just one of the pillars. So potentially there's scope to look into that and see how that might address some of these questions.
Which relate to the presentation. Sorry, Ian, you want to say something?
Oh, I'm sitting here being very patient. I'd like to tell a very quick story if I could.
Sure.
Once upon a time, I ran a company which gathered every transaction of every financial market around the world, tick by tick, and served them up through Thomson Reuters as tick history. So everything, New York Stock Exchange, Sydney, Kazakhstan Sheep Futures Exchange. And we would sell that data and we'd sell it to everybody through Thomson Reuters. And it was really valuable if it was less than 20 minutes old. It wasn't valuable at all if it was more than 20 minutes old. But then we'd have regulators come along and say, we'd like to buy the set of data so we can run our ruler over the transactions to see whether everyone's playing by according to the rules. And then algorithmic trading happened and people wanted our data set because we had data back to the 80s and they were looking for black swan events so they could train their algorithms. And every single trader we worked with had almost an identical algorithm, slight differences here, slight differences there. We sold the same data set to all of them for the same price. And everybody created very different value out of it, depending on exactly that fine-tuned tweak of the algorithm, whether they included a black swan event from the 90s or from 2000 or something like that. My contention here is that we are not thinking about data and AI necessarily in the right way. We really do need different ways to think about the business impact and the potential business impact. And the potential business impact is really not just what you're doing today, doing your old thing in a new way. It's actually what the new things you can do in a new way. And that's hard. So thinking about it really quite differently is what's required. How do you measure the mass of a planet? It doesn't make sense to put a pair of scales out there. You look at how light bends around it. How do you measure the volume of a gas? It only makes sense inside a vessel. It only makes sense at certain temperature and pressure. There are contextual things we need to apply and context limiting things we need to apply in order for us to start to think about the value of data and AI.
Wow, that's a great way to finish off the panel discussions with such an insightful story. But before we finish, though, I'd like to go around the table. I would like to ask you guys to provide recommendations or thoughts. What would you like researchers, practitioners, or standard setters to consider as next steps? Perhaps, Ram, start with you.
I think the first step is to consider how AI as a subset of intangibles, let's say it is, can be addressed within the financial reporting framework that we've got without losing the integrity of the framework, because the integrity of the framework is quite important. It serves multiple purposes, as we know already, and it's well established. So then the next question is, if we can address some of the questions around intangibles, including AI in that subset, Good. Then the next step is, does that answer all the questions that users want? All the information that they want to obtain from a business, have they got it through the financial statements? If the answer is yes, then good. If no, which I presume it is, then what else can we do? What other standards can be created, or what other information drivers can be created to present that additional information? And that's probably where the AASB should be working with the AASB, its sister board, to try and address this particular question. And CP Australia has actually made this recommendation in one of our previous submissions to the IFRS Foundation, where we've said this is one of the areas where the AASB should be working with the AASB in finding a common solution.
Thanks, Ram. Ian.
I think we need to think differently about data and about AI. And I think these combinations of different business processes is a pretty good start. But I think we need to think really, really differently about what we mean by data and what we mean by value creation from data.
James?
Yeah, look, I personally have a similar view in that I think, to your point, approaching this, we need to evaluate how AI has been used across all aspects of labour force, really, because it may be hard to separate it when it becomes so embedded with any interaction people have that's outside of person to person. And for a valuer's standpoint, I would encourage something around a narrative for disclosure framework, particularly on AI spend, what it's used for, what the outcomes of economic benefits are, and so on, so that valuers can actually attribute more of an informed view on businesses cycle throughout the cycle.
Thanks, James. Michelle?
I think I would just encourage a multidisciplinary approach to standard setting and a multidisciplinary approach to research, bringing together these concepts from an accounting perspective, for sure, but from a data perspective, from a legal perspective, from an economist and statistics perspective. We're seeing really substantial changes to the system of national accounts, which are going to come in towards the end of the decade, about how data is going to be recorded and reported. So just as we take these significant steps with, potentially rethinking intangibles, making sure we're understanding it in that full context of how this is happening across the economy.
Thanks, Michelle. Dean?
I'll just encourage the AASB to start research on intangible assets as soon as possible. Anywhere they can start, I would say artificial intelligence is actually where they should be starting. I don't think they should be worrying about anything that's gone to date, working their way back, and hopefully with looking at AI, that they'll be able to develop some concepts that they can work back through to other intangible assets. I suppose the key part for me would be that there's probably some significant cross-cutting issues within the standards already that they need to address, and that this would be a good place to start. I suppose the only other thing I'd probably say is, and probably it's very similar to what everyone said today, interdisciplinary would be really important. I think the AASB has to think of this project a bit differently to the ones they've done in the past, and actually see if they can leverage skills from outside of the board, really looking to people who are actually involved in that practice right now.
Thanks. Nafis?
I think we as a researcher, I think we need, of course, we need more money to do this research. Because if we look at, we did some hand collection only for 2 years. It took us like 2-3 weeks. So I think I agree with the digital reporting. I think this is right. We should need XRPL to isolate these information so that we can extract these more easily. I think this is the challenging part for the researcher. Like, we want to do this, but we can't do this because it's a lot of work to do. I think that's why I think more research will come, of course, but we need more resources.
Thanks. We're right on time. So, well, thank you for the presenter and also the panel for the discussions. Please give them a round of applause. Okay, so with that, we're going to finish this session. We'll start the next session in half an hour, 3 o'clock in the afternoon. So I'll invite you to have morning, afternoon tea with us. Thank you.